Good evening, everyone. My name's Justin Hams, the Senior Portfolio Manager at Real Estate Investor. And I'd like to welcome you tonight to our webinar, How to Find Positive Cash Flow Property. Look, we do appreciate you coming just before Christmas and so on. We understand that everybody's time is precious, so I'll endeavour to make this as informative and interesting as possible for you, and so you can utilise the time well. Okay, so with that in mind, let's get into it. Okay, so just a little bit of housework first. Please ensure your speakers are on and your volume is up and not on mute. You can also test the audio in the control panel of the GoToMeeting software that you'll see under audio preferences. If anyone can't hear us, please just check your speakers, because a lot of time that will be the problem. If you've got any other programs running in the background, such as some of the ones you see, Outlook, Skype, and so on, please, if possible, turn them off, because it will slow down the actual webinar for you as far as what you get through. And of course, the faster the internet connection you have, the better the audio quality that you will get from myself. Okay. Obviously, the general disclaimer tonight, the information I'm going to be presenting is general in nature, and if anyone is going to be acting in any way from the information, please see your professionals, whether it be financial advisors, accountants, and so on. As I said, this is not tailored to individuals. It's a general advice only, so please take it as such. Okay, a little bit about myself. I've been investing personally and for other investors for over 25 years. I'm a qualified buyer's agent in several states, and I research property for a living. I've also been a renovator full-time and done a landscape gardener, carpenter, painter. So I do have a lot of experience growing up in and around the building and real estate industry. So hopefully I can give you some pearls of wisdom tonight from some of the things I've learnt along the way. Okay, what does our company do? It's quite specific that we build and manage property portfolios for investors. We can do it via either helping you do it yourself or giving you some help along the way. But who are we ourselves? We were founded in 2006, and we presently have offices here on the Gold Coast, where I am tonight, but also in Melbourne, Auckland, and Christchurch. We are ASX listed, and our chairman is the former chairman of realestate.com.au, being Simon Baker. The base of members we have that have access to us are approximately 300,000 at present, and we really are a data-driven company where we actually do all the study of statistics and data and don't get an emotional status to do with anything from it. It's basically all about the numbers, nothing about emotion. If we keep that out of it, our mind will be clearer to make informed decisions. And of course, our tools themselves, not only do I use them personally, and I will be showing you some of the ways that I get successful outcomes from it tonight, they are unique across the world. There are other places that have bits and pieces of what we've got, but none across the board how we've all got the suite together. Now, we also have a full acquisition service for a buyer's agency. That would be myself. I have lived in 4 states of Australia and travelled across most of it, and I'm constantly travelling. So if you live in any of the states and you need some advice from me, please feel free to get in contact with us, because I have a lot of knowledge all the way across Australia because of the amount of not just buying, but travelling and intimate knowledge on the ground of several different states. Okay, so who do we partner with? Obviously, Domain, round about the 350 to 400,000 of different site listings on our software at any one time. Of course, Price Finder for our data analysis or part thereof. Your Investment Property. Also the Self-Managed Super Club, which is obvious what that does, and Xero Accounting Software. The one we have in our suite of tools is specifically put together for property investors. And also, of course, Law Lab for the conveyancing, and Washington Brown for our depreciation expert services. Okay, so the actual cycle itself, it might look pretty simplistic and so on, but it's always to remember good to remember that the simple things are the things that keep us on track when we start our minds going wayward and so on. So if we just stick to things like this, we do our searching, We do our analysing of the results of our searches. Once we find something that's acceptable to us via whatever strategy we're going to be using, we acquire it. But of course, we don't just sit back and leave it. We need to track it and see how it's performing, if it's good or it's bad, or how that we could possibly improve it whilst we're monitoring it if it's not going to the heights that we would like it to go. And of course, we account for it as far as our debt serviceability and our loan to value ratios, whether it be one property or your whole portfolio, to see when we can replicate it and go all over again, which is the goal. Okay, while we're all here tonight, how to buy a cash flow positive property. But of course, the question is, what is a positive cash flow property? Breaking it down to simple terms, it's a property that actually gives you money back each week after all your costs. It's not just for the mortgage and just for your property manager and so on. It's any utility costs that you might be paying if you're paying for the water of your tenants are in there. Is it a townhouse or a strata or something where you're going to be actually paying strata fees? All these things, especially when you see in an agent's listing for a strata place and so on, a lot of the time, the strata costs will not be taken into consideration when they're advertising the yield of what the property gets out. This can be the difference between something actually being positive cash flow or not. And of course, the number one thing and the only way to get truthful outcomes about whether a property is cash flow positive or not is crunching the data and doing data analysis. That's what I'm going to show you to do tonight using our software and how I use it personally when I'm actually searching for clients myself. Now, of course, the goal being that we purchase balanced investment property. When I say balanced, it depends on what strategy you've got. It depends on what number property it is. Is it your first property? Is it your fifth or sixth? Because your portfolio, it needs to be balanced via cash flow and via equity to be able to keep replicating. It's important that we tailor each investment property to keep it going along the way. So we don't max out as far as the financial institution that you might be going to thinks that, okay, you've got too much debt in here and I want you to consolidate or capitalize something. This gives you the availability to stay in control yourself, because if you're aiming for getting the right property at the right time in your portfolio, then your goal is generally going to be able to get you to where you want to go. It's not just flying blind and so on. Okay, so obviously there's pros and cons with any strategy. Now, for cash flow positive itself, of course, the number one thing that it's great is it's not costing you anything. Now, obviously, it is costing you to pay the mortgage back and maintenance and things like that, but it's not pulling money out of your spending income per week. And of course, once you start getting more than one property, it can help balance out your portfolio like we previously spoke about. Another thing too is finance institutions and so on. They're going to want to make sure, depending on how risk adverse they are, that your debt serviceability ratio, whether it be one property or many, gives you enough scope for them to be comfortable, for them to lend you more money to go for another one. And of course, the golden goose out of all of them, find a cash flow positive property in a strong capital growth area. Not impossible, but of course, it's much harder to do because they're less on the ground, of course. Now, the cons as well, the extra income you make is taxable, and basically not all the time, but more often than not, the cash flow positive properties, they won't be growing at the same rate as what a property in a blue chip suburb would be, where the yields will be lower, but the capital growth will be lower. So of course, it takes longer to build up your equity and so on. And generally, they'll be in suburbs that are lower as far as the entry level price is concerned, or regional areas. Now, of course, I am generalizing, but you need to know this. And of course, if you can find a good one in a good area and get strong capital growth too, as we've put in the pros as well, then that's obviously a replication that's been put into the slide, so my apologies. Okay, Now, this is the same across pretty much any strategy, but I like to leave this in because when you're actually looking for a property, all these points are important to go along the way. So if you can find someone, and I'm not talking about taking advantage of a vendor or someone that needs to sell, but if you can find someone that is highly motivated to sell, the reasons for which are not important to us investors, we just want to do the best we can, of course, as a vendor would do. We check the suburb health. Well, what does this mean? It basically means that where is it at present as far as growth, as far as infrastructure, where has it come from and where's it going to? Is there planning that's not only on the board or drawing board, so to speak, but it's actually been approved? So we know things are actually going to be happening in this area. And of course, the listing history. This tells us a lot about the property. Any individual properties listing history can tell you a myriad of things that have happened to the property or the people trying to sell the property before you've actually got on the scene, so to speak. If we're watching it go down 3 times in the listing history and we're watching a large period of time that's it's been between the original listing of the property and when you're looking at it now, of course, unless someone doesn't have a mortgage on it or unless they don't really care about the property, they're probably getting frustrated or they're probably more likely to be negotiable. And another thing too in the history, if you can see they've gone from one agency and they've gone to another agency, you can tell that's a sign that they're frustrated that the first agency did not sell the property. So at the same time, more possibilities for negotiation. Also, a very important one, recent comparable sales of similar properties. Now, when we talk about similar properties, we are talking about dwelling types. So if we're looking at a house, we're looking at a house. If we're looking at a house that's a 3-bedroom house, we want to only look at other 3-bedroom houses. Because when you will hear, people like the general media saying that the medium house price in this suburb is this cost, well, it's too generalized because a 2-bedroom house is not the same as a 4-bedroom house and it's not the same as a 6-bedroom house. We need to be more specific and measure apples with apples because it's giving us a much more accurate idea of what the true comparable sales are for what we're actually looking at. And of course, we want to forecast the property's long-term performance. What's our goal? Where do we want to get through with this property? Do we want it to capitally appreciate? Of course we do, but is this our main focus? Or is it more important to us that this one just chugs along, it's making some good capital growth, but it's giving us a little bit more spending income for whatever reason that suits you? And of course, the time of your purchase. Now, you would hear a lot of people say, never sell your house around Christmas like now. There are pros and cons for that too. Of course, there's not going to be as many buyers on the market, but at the same time, there's not going to be as many properties on the market either. So it can be a time of advantage as well as disadvantage. So it's important to remember, don't generalize about time. It's more about the demand of what you're looking for or what you're trying to sell. And of course, establish your maximum ceiling purchase price. Where people can get carried away with this and where they get lost in this is at auctions. Get it into the excitement and so on of the moment and the atmosphere. And of course, there will be real estate agents that are linked to the auctioneer that will be there to gear you up and keep you excited to try and to get you to keep bidding and so on because they're working for the vendor. So always remember, if you do go to an auction or if you are negotiating and you do have a maximum ceiling price, stick to it. You are doing this to invest. You are not doing this from an emotion point of view, so you need to take the emotive side out of it and think with your head, not with your heart. Okay, so the tools themselves. I use these every day personally, and not just because I work for the company. I used these tools for 3 years as an investor before I worked for the company. So I knew them inside and out. But of course, since I've been here, they've been updated quite considerably. But I always knew the strength and the capability of what these tools could do in such a short period of time. That was the biggest thing for me personally, saving time and being able to get to such a much broader amount of research in small amounts of time. So let's go into it. So if we have a look into the search, tonight being obviously we're going to go from a cash flow point of view and so on, but I just wanted to throw a little bit of facts and so on. There's 900k plus listings from 40 different Australian property portal sites. Now we've got 900k there. Look, I can tell you now that is actually conservative. It's not uncommon to have 1 to 1.2 million results that the actual software has gone through via your criteria to bring back whatever the outcomes have. Now, I'll go into that a little bit more later. Now, you can see there's 34 filters or ways that you can amend the searches. If you put every one of them on, you get no results. So we always start, obviously, for our biggest priority, what we want, whether it be a house, whether it be the suburb, whether it be the price point that we're going to come in, and we drill down as we get more and more hits back. We basically want to get back somewhere between 50 to 100 results, and if we're getting back way above that, we keep adding our criteria to make it better and better for our personal search for whatever we want to get out of it. And of course, the advanced data that we actually have in the system is phenomenal. I'm going to show you a small snapshot of it tonight because we only have around about an hour and so on. And obviously, me actually using this every day and knowing it intimately, I could talk to you for hours on it, on the possibilities of different things you can achieve from it. But tonight, I'm going to keep it generalized. Of course, the system will have watch lists as well, where you can keep your eye on properties and like favorites and so on. So anytime that you need to go back and have a look at it and see, obviously on the way to an auction or to see if it's actually selling or not, and also save searches and email alerts for the particular strategies that you're going for. We've got over 2,700 suburbs that can be analysed in the system, and as we spoke about previously, the system is globally unique. Okay, so I've gone into that front screen here, and I've done basically the strategy is positive cash flow as for what you guys are all here tonight. Now you see to the left of the keyword strategy, or to the right-hand side of the map, you've got your select keywords. Now what this does, when we're putting this information into the system, every one of those particular phrases, whenever it is listed in the listing material that an agent does in his ad for a particular property, via whatever the rest of the actual different criteria that we put in, this is going to be what comes back in the outcome of our results and so on. So for this one, I've just kept it super simplistic, and I've just put that in Queensland. And I'll go through a little bit further into the next slides and show you the results of that. But of course, these are the keywords broken down a little bit further. Now, this is just for the positive cash flow strategy that we've been talking about. Double income, granny flats, positive cash flow, sleep out, 2 incomes, all these things. These are just a few that I've picked out that are the ones that stand out more for me out of the large bunch that I could only fit so many onto this page. Okay, so the result of coming back, what I've done here, because I wanted to look at houses, I've put a minimum suburb rental yield of 4%. Now, it's going to be for you to come comparable or towards positive cash flow in a house, depending on where the suburb is and the price you pay for it, of course. Remember, I am generalizing. Roughly 4 to 5% is going to be on the way for a house to be positively geared. Of course, the high-end acquisition price houses, this doesn't apply, but we're talking the lower to the middle income. Now, if we're looking at a townhouse or a unit, it can be anything from the 6 to 8% rental yield for you to be positively geared, to take into account all the extra fees such as the strata costs and so on. And of course, if you're in a compound with lifts, swimming pool, tennis courts, then the strata is going to be higher again. But you can see from here too, we can manipulate this data for growth in the suburb as well. So if it's important to us, okay, we want something that's positive, but we're going to have a minimum amount of growth in a percentage rate for a year, that's all we're going to look at, then we can put that in. But of course, if we put too much criteria and our wish list is too high, you're not going to get as much results back. So we've talked about that, the rental yield percentage and so on. Now, from that, I've just done a Queensland search. You can see I've looked at a minimum gross yield for these properties of 4%. And we've got these three that have come back, 4.5, 4.6, 4.7. So there obviously is more, but I couldn't fit this on the page. So I thought I'd go for the one that's got the highest yield, and Capalaba, which is southeast of Brisbane. I like this suburb because it's a good entry-level suburb, and it's not far from the water, and it's also within very easy drivability to get to Brisbane CBD as well. It's important too to note, whenever we're looking at any of the results for our property, have a look at the growth or the lack thereof too. See the graph that we've got sitting to the right-hand side of all the properties? Whenever it's got a green in it, it means obviously that it's gone up for that particular year. The last four being broken down into quarters. So for our property here, now this is quite specific too. Now, a house, not just a house, but a 4-bedroom house only in Capalaba, the median listing price is $539,000. This one at $495,000 is already under the median at 91.8. Now, normally I wouldn't worry as much about the median when I'm looking for a strong cash flow property. If I can get it around the 100%, I'm happy. If I can get it at a discount, even better. But a lot of the time when you've got a high cash flow property, it's not going to be at a high discount because it is taken into consideration by the sellers or the agent that it's selling for. Now, when I was actually looking at these properties too, I was doing some comparable searches from above. And there was this property that I've just focused on right now. And you can see too, see where it says granny flat? Great family home with granny flat. Wherever it's actually faded out like that, this is where the algorithm of the software has come in and grabbed this listing. That's one of the keywords that we talked about earlier. Always read what the listing says. Reason being, if it says potential income or you should get this income or appraised income, it's not actual. It's a guesstimation. As you can see here, this property is renting for $530 a week. Now, when we can see that it's at $495 buy for $530 a week, and it's not a townhouse or a unit or anything, so we haven't got those extra fees and so on, this is most likely positively geared. When I was looking at this, I actually went across and I found something else, which I was pretty keen on, which I'm going to show you in a minute. Now, Analyse in full. This is one of the strongest parts of the software that I really like, because before we even put our hand in our pocket, before we go out and do building inspections, pest inspections, anything else, getting any professionals to come in and look at the place, at our cost, this is a way where we can get our ticks in the boxes to say, okay, this is worth our time and possibly some of our money to investigate this further. So if we go into Analyse in full, you'll get the property breakdown and so on. I've sort of chopped and changed here, but there's a reason why I've done this, and I want to let you know right now. When I was looking at those Capalaba properties, I was doing an aerial search, which I'm going to show you a bit later in this presentation, geographically around the property of similar type properties. This one came up that I was quite interested in, the rationale being that the median listing price is $635. It's a good size block. I haven't actually made any investigations into it myself personally, but I do know the agent that's listing this, and he's normally pretty spot on. So this is actually a live listing. So if you guys are interested in having a look at this, I will show you why I like this property, and I'll use this as an example. As I said, it's a live listing, so if it's still available tonight or tomorrow, give the agent a call. But I'm going to tell you, I would normally look at this for one of my clients, and the reason why I couldn't make this work for the current clients I have, because all the clients I have in about this area, they're all renovators that want to flip. Now, this property, if you could get this somewhere between the 540 to 550 mark, and you don't have to do a renovation, but if you did do maybe a $50,000 renovation or so on, you're still below the median listing price in the area, and it is definitely going to be positively geared. And I'm going to show you why through the investigations I did on this. As I said, I would have given this to one of my clients, but I don't have any of my present clients that match this strategy for a reno or just buy and hold, because this is a good buy and hold and you will make money on this, and I'll show you why. Okay, so we're going to the Analyse in full, and this is for this specific property I was talking about. Now, you can see this is what will come up. It'll come up as a default as far as the analyzer, but we can also see that it comes up with whatever the property is that you're actually looking at. Straight away, we go in and we edit it because we want to make sure it's accurate to our personal circumstances. Okay, so let's go in. The first thing that comes in, what's your deposit? What's your LVR? So I always do my research on 20%, so we're not going to be paying lender's mortgage insurance. Now, those amounts that I was guesstimating before, saying if you could get it for 540 to 550, I've put that in our example. Now, of course, this is not for sure or anything. I'm showing you possibilities. If we could get it for that, the system, no matter what council you're in, no matter what state you're in, it will automatically calculate your stamp duty and rough solicitor's costs for the area. You have the availability down the bottom for putting in loans, whether it be principal, interest only, split loans. It's only, the only way you can stop the possibilities of it is your own personal circumstances. You can see too, for the interest rate, I've put roughly 4.5%. You know, I think that's fair. I think most people could get at least that. Maybe, you know, several people get better, but I wanted to make it quite conservative. So that we go through this part, I've got all my figures in there, and I go through to rent and expenses. Now, I've put 525. The medium rent for a 4x2 in this area is 540, but I want to be conservative again. So the figures that we have on the outside are easily achievable. The rates are coming in automatically through the system's algorithms linked to whatever the council the property is sitting within. Repairs and maintenance, I always just roughly put that as about $1,000 for an okay property. If we've got an old Queenslander with weatherboards and things like that, I'll generally bump it up to about $2,000 a year. The insurance, same thing, it'll automatically come in, but if you know exactly what the insurance will be in the area, make some calls, you know, get some quotes, you can make that more accurate. And management fees, depending on who you know, how many properties you have, the amount of service you get from a property manager, they'll roughly range 6 or 7%, so I've just put it at 6. So tax in the market. Now, this is important too. The market factors currently in Australia across the board is around about 1.9, 1.95. So I've put it at 2%, which I just leave flat. Now, whatever the actual property where it sits, now in this case specifically a house in Wellington Point, we've got 2.9%. The region it sits within, being the Bayside South, is 2.5. So normally I would just put this at 2.7, whatever's in between. You'll notice in the capital growth, I've got 3.8. Now, these figures for the house and the region, they get updated at the first of each month, but they also go back for 5 years and so on of averages as well. So it shows a historical timeline that's rolling forward. That 3.8 is as of now. So I've put that in to show you what it presently is. And of course, you can manipulate any of these at any time you like. Now, the property is medium quality, being a brick and tile place from 1995. So I've got all that in for my depreciation schedule. Of course, only get a depreciation schedule if you're going to keep the property. Otherwise, it's a waste of money and you will probably have a tax debt if you do it and sell it in too short a time frame. Okay, so we've got that through. I press my results. Now, these are the important things that we need to look at. The gross and net yield of the property. Remember we talked about before, this being a house, we want it to be at least 4%. Now, there are governing factors which show the possibilities of us coming out this on the positive or in the black, so to speak. If we know the capital growth rate is 3.8%, that is going to tell us if it stays at that current rate and we buy it for 545, within a year, it'll be 20 grand more. So if we know the rental income, then that is going to be the figure that we get at the bottom end. So if we know what the capital growth rate is, what we're going to pay for it, how much the interest rate of our loan is going to cost, and what we're actually getting in. If we've got all these figures, we can be very accurate at the bottom end. Being, okay, we've got our interest rate at 4.5. We can see here, this is before tax. It's $1,500 cash flow positive, so $29 in your pocket. But after we put our depreciation schedule in place, it's actually $44 a week positively geared. Now, some people might be saying, oh, that's not very much money. But if we're talking about a house it's not far from the water, it's in driving distance from a major city CBD, it's putting money in our pocket, and in the first year alone at current growth rates is putting equity of $20,000 in our pocket. This is quite a good return for something that's not at the higher end. Now, this shows you the capability of the software, because we can crunch all these numbers before we actually do anything, before we go and look at the property, before we spend any money. It's a massive advantage time-wise to get rid of things that not only that we can source out to be good, but the ones that look good on the surface, but when we crunch the numbers, we can actually see we'd lose money on them. So there's advantages for it from both sides. Okay, we've got, as part of the software, My Value and My Research. This is run by Price Finder. We've got a free 7-day trial as part of the software. Now, some of you, if you've seen any of the webinars from the past and so on, we actually used to have this as part of our software, but because of new licensing laws, Price Finder they have to be paid directly and billed directly to them now. So the difference between you going to them outright or through us, it's for us, our members will get it for $55 a month. The retail price you can see down there is $192.50. So I'll talk to you further about that in the presentation, but this is what I use it for. The same house that we've just talked about, because I wanted to keep using this example so you can see the line of research in what I do when I'm hunting for something for a client. Okay, so we see the property itself, all the information on it. The part I really like, sorry, I'll go back there. The part I really like about this in cross-reference with the analyzer as well is the maps and so on. Okay, so we can see here, we've got the property amount, the sales history. What did these people buy it for? We can see there $508,000 in 2012. So they've had it for nearly 6 years, and if we could get it for that 545 roughly, and of course I'm being hypothetical, then that's not a lot of growth for them, but at current growth rates and with the amount of rent that we know we could get as far as medium rents for the area, for the dwelling type at this time. And I can tell you too, in this area as well, the vacancy rate is less than 1%. So that being the case, the demand to supply is not enough. The supply doesn't make up enough for the amount of renters that are looking in the area. So houses rent very quickly. Okay, what we talked about before, the sales history is very important to us. So how long has this one been on? Now, as you can see, this has only just come on and there's no price on it. But if we could get it for around that price that you guys and myself have been talking about, I can show you that the figures can work as we've seen before. Okay, what we talked about too, if it's gone from one real estate to another, when we look at the for sale history as well further, then we know that something is not untowards, but the actual vendors are not happy with what's happening at the moment. As you can see, Ben Stanton's got this on at the moment. It's only been on for a week, so it's a very new listing. Okay, so the actual comparable sales, what we can do here is we can do a geographical and a time stamp the way we actually get our results. So as a default in the system, it'll give you a 500-meter radius, whatever the property is that you're looking at. So for this one, I've just put in, I wanted only other 4-bedroom houses. I only wanted other 4-bedroom houses with 2 bedrooms within 500 meters of our target dwelling. So as you guys might or might not be aware, you can have 3 markets in one suburb. If the suburb goes on a flat, goes up the side of a hill, and then is up on a peak, there's 3 markets. you have the base market, the market on the hill with better views, and the market up with the Eagle's Nest views on top. That will be 3 markets. All the more reason why it's important for us to get our comparables as close as geographically possible, as well as matching the standard or the condition of the house and the type of dwelling. There's no use matching a 4x2 double-story weatherboard with a single low brick house. We need to get as close as possible because this gives us the true indications of whatever has sold as close as possible and in the shortest time frame from when we're looking to give us the most accurate comparables that we can get. We can see here too, down, look at the distance, only 335 meters, next one 286, 78. The one at the very bottom, which I didn't give you a chance to see, is 7 Folkestone Court. This is a house that's 4 or 5 doors up on the same side. Now, I went in when I was doing this research myself, because you can click on all the pictures and actually see from the previous listings all the outside and inside of the house over a time stamp. Now, this one you can see 610. It sold for around about 6 months ago. Admittedly, this is a house that is in better condition on the interior, and you would have to do a renovation to get it to this standard. However, if you spent, and of course, this is a generalized term from myself because I used to renovate. You need to spend the money and get professionals to do the work standard-wise, or if you're confident yourself, make sure you do all your homework first before you spend a cent. To get it to this house, I believe you have to spend $60,000 to $70,000. But with the growth in the last 6 months too, if we're looking at 3.8, so roughly half of that over 12 months, so 2%. So if we're going to add that to this, then our brand new shiny property, if we spent say 60, 70 grand, is going to be roughly the same at this, somewhere between the 620 to 630 mark. But it's still right on the medium. You've got a brand new shiny place to rent out and to grab the equity from as well. And of course, this is in a high demand rental area. You're going to have people fighting to rent it. Okay, so the actual sales themselves, the comparables that we talked about, this is how we actually go through and get the actual results for what we're looking for. You can see at the top left, I pretty much, most of the time, I will go for a 12 months date, but the system gives you a default of 6. So for, training sake and so on, I've just left it at 6 months. I've put it as a house, but I have been less specific as far as the sales, because I wanted to get the whole suburb here for Wellington Point. Now you can see in the criteria summary, I have actually gone for a year, and in the last year, there's been 213 sales of houses. We get the statistics from those houses being the highest at 3.5 million, which would definitely be on the Broadwater, right by the sea. But our average and our median at 625 and 684. So our median sales price is what we would normally look at as far as our marker to what the average in between all the properties being in this area would be. So we can see the average is 700 meters square, the actual gross floor area of the land, and our example is over that, I think at about 720. But if we did a renovation, we'd be up to the same medium roughly. But you don't have to do the renovation as well. Those figures that I've done at 525 for the rent, that's as is. This is another very good thing, is especially if you're looking for future change of use and so on. If you become aware or you know of particular places from one side of the road to the other where the zoning's different, this is quite regular, and it's advantageous to know what the zoning is if you're going to make any changes. If you're just doing renovations or just buying in a good area for capital growth and cash flow, it's not as important. But it does give you the capability to search within very specific parameters. See, in this instance, I've done it literally but around 2 massive blocks of main roads. I only wanted to look at properties in that area specifically. It could be for any reason. It could be from the zoning that we talked about. And sometimes too, from one side of a major road to another, I'm not exaggerating. It can be $50,000 difference even in a $500,000 house. If we are aware of this through our research and we see on the better side of the street something coming up, even if it needs some work, we can see through our comparables and through the research we've done, it could be a much better buy than the one across the road, even if the one across the road is, say, 20,000 less. The one that's more expensive on the better side of the road that's worth on average $50,000 more could put $30,000 equity in our pocket. Okay, same thing. I've just pressed search from those parameters in the map that I've just done before, and this is what I got that came back. So in that little specific area of Capalaba, we've got the medium at 580 for houses in that region, and that's over the last year. We can click on any of these houses too, which will give us the actual sale price and also the date that it was sold as well. Okay, the interactive map, this is where we see what is around the property. Has the property got a tip near it? Has it got fantastic things like some bushland like this one? Or it got a really good park or sports field? Is it near a main road? Is it near a train line? Is it too close to these things? Is it perfect distance? All these things make a difference to what the property is worth. You have a lot of availability to manipulate the data over here, and you see I've got property shading in the big yellow oval, and I've got it via sold price. So our target property that we're looking at here, I've just clicked on, and anything within the map vicinity where we've got the shading, it's going to tell us, if you can see the legend at the top, anything with the aqua color is between 500 to 750,000. Same thing again, these tells us ones that have sold in recent times, and if we click across from sold price to sold date within the grid, that will go and tell us via colors whether it was 12 months, 24 months, 36 months or greater when the properties were sold. So of course, the yellow being 12 months or less are the ones we're going to click first because they're the closest data in price and time. Okay, so we go in here, we can do a suburb flyover. This is brilliant when we're actually tailoring whatever the property is to the demand. And what I mean by that is certain areas you're going to rent or you're going to sell to families. Certain areas you're going to have young professionals. If we know the demographic of the actual buyers or renters in an area, why wouldn't we hunt or give them what they want? Because then the demand or the greater amount of people that are fighting for our place is going to be higher. So of course, we're going to get higher rents or more money for our place. Let the buyers, not yourself, when you are selling, be the emotive ones in this thing, if you're selling. You can see too, on the right-hand side, there's a myriad of information over mediums and time, and also growth or drops of growth. So we can see here all the way from 93, where the medium for a house in Capalaba was 132, and we're up to 500 this year. You can also see the years that have moved quickly too, and the ones that haven't. Like we've had a very big growth between 2003, 2004, 37 and 14% respectively. It is important to note too that the number of sales make a difference to this. The fewer the sales, the more the figures can be skewed. So looking at these as example, 2003, 2004, there's high amounts of sales. So we know that those high growth figures are factual rather than skewed through the amount of the pool of data we are looking at. Okay, the demographics that we talked about before, the ages of the population. This matters because depending if you've got young people, and in this instance in between the 20 to 39, they're going to want different things out of the area around their place. They're going to want more cafes, possibly nightclubs, more bars and so on. But if the demographic is on the higher side and middle-aged to latter, being from say mid-50s through to 60, 70, then they're not going to be as popular. The noise that comes and the parking and traffic with those are going to be a deterrent. So if we know the age and the composition of people that are actually looking to buy or rent in our areas, then we can tailor it to those things. So as you can see, what we were talking about before, we've got all the family compositions, the employments. These are important things too, because if we're in an area where it's more blue collar, a double garage is going to be more important, especially if you've got a tradie and so on. He wants to keep his tools safe and maybe keep some supplies and so on. But if it's a much more white collar area, it's probably going to be more important to some of the people that want to live there that the garden is a very low maintenance, because they might work longer hours, or they don't have time to do that. So all these things, when we cross-reference them, as far as all our ticks in the boxes for our criteria, it gives us more and more idea when we're heading towards the right answers to whatever the strategy we're looking at and the outcomes we want to get. And it also gives us all this information before we spend money. And also the time, and time is money. So this is all a huge advantage for you guys. Okay, so the tools are basically built for do-it-yourself investors. As I spoke to you before, I can help you guys do it, but we could talk about that offline as well. But the presentation tonight is really about me showing you just one strategy out of several on how to get the outcomes of the research that you want to do in quick periods of time. If we're talking about over 1 million listings a lot of the time, no matter what you're searching for, you can imagine how long it would take you to sift through all those to come back with 20 or 30 or 40 that are the most relative to what you want to achieve. This is why I use the system myself, because time to me is very important. So the less time I can spend getting accurate answers to the research I need, it helps me give informed decisions to the clients that I have, and you can do the same thing for yourself. Okay, so tonight, I don't know if you guys have seen any of the webinars before. We've had some prices. This low is the lowest we've ever had. And there's two reasons, actually three reasons for this. One, we're coming up close to Christmas as well, so a bit of a Chrissy present. We've also recently had Price Finder. All the licenses have changed and so on. So we want to make it as attractive for you as possible. And something else to remember too, guys, of course, talk to your accountant. But if you even have one investment property, the fees for searching for other investor properties, such as our software at $79, it's 100% tax deductible. All you have to do is talk to your accountant to confirm. As you can see, the normal prices is $149 for month to month, no lock-in contract. If you want to go further and go for your 12 or 24 months, there's the prices at $14.90 and $19.90 respective. You can do it as an individual. You can also put it in your company name if you're doing it for a business service as well. So as we talked about, we're opening this up to the first, what is it, the first 20 people, if I remember correctly. You've got, first 20 people that sign up tonight. Now, I will be doing a recording of this so I can send it out, and I believe all the participants that have come tonight along will be getting a copy of the recording as well. But be aware, guys, if you do want to take advantage of this and go back in our history and so on, only recently have we ever offered our software at this price. So if you are looking for a property now, if you are looking to do some comparables for maybe how much you should spend on a renovation to gauge selling or gaining equity, it's a very small price to pay to be able to get clear factual information by crunching the data. Just think about it. If you were going to get a building inspection, a pest inspection on one property, you'd be spending several times this over for a month. So you can get on board and do that. It's you can sign up now. What I'm going to do, I'm going to put my apologies. That's just wiped itself out. There we go. I'm going to type this link into the chats for you guys. So if you want to get on board, and straight away you can get in on that. I'm going to answer some questions. So that concludes tonight's presentation. So I hope you enjoyed. the information that I've given you tonight, and happy to speak to any of you guys offline after this in the coming days as well. Just bear with me, I'm just not the fastest typer. If I could type as fast as I could talk, you'd already have it, but it's getting there. All right, guys, so I'm just sending that out to you now. So if you click on that link, you guys can get on board nice and early. So what I'm going to do, I'm going to start answering some questions, but just before I do that, please excuse me, I need to have a drink of water because I've talked a lot of words for a bloke in one day, so just bear with me for a second. All right, I'm back. Okay, so I'll go through some of the questions now. As I'm a retiree and self-managed super fund, what are your thoughts on buying cash flow properties for yield, not for overly interested in growth as it's a block of units? Look, obviously I can't talk about individual circumstances. Cash flow is very important for your portfolios to be able to replicate. It's also important for you to be able to say to your bank that my serviceability is okay. If you can get that in conglomeration with capital growth, that's even better. If you have time, your capital growth is where you make the most money, but your cash flow is what enables you to keep doing things for now. So I wouldn't look just for yield to the gentleman that asked that. And of course, I don't know your personal circumstances, so I'm answering in a general nature. Okay, what is the best way to research the data on the city you're interested in investing in? That's going to come down to your strategy, and it's going to come down to how much money we're talking about. Because if I'm going to be blunt, money is the first thing that governs the geographical area where you can go and the type of dwelling that you can buy. So that, when we cross-reference that with whatever your strategy is, that is where we're going to be going as far as the locations. Because if we're talking about 500,000 and we're saying, okay, I want this as close to a CBD as possible and I want a house and I want 700 square metre block, it's not happening if we go to Melbourne. It's not even happening if we go out to Cranbourne in Melbourne as well, because most of the blocks out there now, the 350 to 400 mark, especially around Cranbourne North and going out that way in Hampton Park and so on. All those areas, you can still get a house for 500 grand. It won't be new, but at the same time, we can go to other areas, and if you're going by the cash flow, we can get something good for that. I'm not saying it's not good in Cranbourne North. They're great areas for good growth, but it all is deemed down to actually how much money you've got and what your end goal is. Because we start with your goal and then we work backwards from that. We work out the steps to get to that goal and make it the most likely that we're going to achieve it successfully. All right, next one. What is the source of information for the rental on the database? All the information comes from the agencies that actually list, the agencies that have listed, and the price finder as well. That's the data source that we get it from. But remember too, we've got 40 different property servers coming in. So when all the ads come in from all those different agencies, and when they come off the market as well, they're listed in the actual data material that we look from. So that's a very good question, because that being the case, we can see, if we're going to do a reno on a place, we can see what the comparables are, like you guys and myself were talking about before. If we're looking at specifically, let's say, a 4-bedroom house in Capalaba, like we looked at, and we know it's a particular rent for that area, and we know that other houses have rented for, say, $490 in the same condition as ours, we know that we can roughly say that we should get $490, especially if the vacancy rate in the suburb is below or equal to around about 2.5%. That's equal supply for demand in most metropolitan areas in capital cities of Australia. So if you're looking at below that 2.5%, you know there's more demand. If you know you're going over that 2.5%, it's edging on the side of more properties than people that want to rent them. Okay, so if we're going to do, going on from that just a little bit further, if we do the renovation, then we can actually look at houses before we actually do the reno, close proximity again, similar house to ours that have already had renovations done. And let's say, for example, before at 490, after we've done our reno, we know one's in the area, similar property to ours, and we know they're getting 550. So that gives us an after renovation estimations of what we should be getting in for our income before we've actually spent the money to do the reno. All about the data, all about the research, nothing to do with any type of invested emotion connected to the properties. This is how most successful property investors work and how they think. It's a business. And if you guys can do that and look at it that you are in the business of investing in real estate, then you're going to be much more likely when you couple this with sound research to make informed decisions that are going to give you much more likeliness to have successful outcomes to the goals that you're looking for. Okay. We've got a lot of questions coming through. We can't copy the link. Okay, the link I sent through, if you can't copy that, please just copy it and type it into your browser and then enter, and then it should come up as well. Okay, can we trial the software before we buy? No, you can't, and reason being that we actually pay third-party data providers as part of our software suite of tools. We used to do it years ago, but at that time it was $199 to $249 a month. So we had a lot more margin to be able to give people a test drive and when people came on board. Reason being, you know, costs have changed, the market has changed as well. When I say the market, I'm not talking about, you know, any suburbs and so on. I'm talking about the data providers where all the contracts and so on. Of course, we pay to get this information to you guys. So as a company, we need to make something. So the trialing the software and so on, it's actually a negative for us. So we don't actually do that anymore. Can the tool be used to search for commercial property? This is specifically put together for residential property. However, you can put any property in to actually research the property itself. You can't do the comparables like I've showed you tonight on commercial property. As I said, it's designed specifically for investors. You could use it for, you know, getting your own principal place of residence as well, but it's designed as a residential one. Okay, what are my thoughts about display homes for sale often for 6 to 8% as a back lease? Look, that's going to depend on where the property is and how much of that has been actually taken into consideration into the purchase price. Now, what I mean by that is, let's say it's a 500 grand house. And if they've agreed to lease back to you, this is a developer, for a couple of years, it's very likely that $500,000 house will be touted or released at 520 to 530 to take into consideration the extra costs that they will do that. It doesn't mean it's always a bad idea. Don't get me wrong, some display homes are fantastic. And although I predominantly buy existing property for my clients, new property gets a bad name as well because of certain areas and certain companies, which I'm not going to talk about. That's irrelevant. You can get just as good deals with new homes as what you can for existing. But like anything, you've got to do your homework. Do all your research. So as we talked about before, make informed decisions from the outcomes of the research that you do. Now, the gentleman that asked that question, find out what are other houses in the area. And hey, if you want to come on and get the software, you can do it with that, with the address of the property that you're talking about. Then you can geographically go around it and look for what other houses have sold that are similar condition. Obviously, they're going to be brand new too, and they're going to be the same makeup, same building type, how many bedroom count, and things like that. That's a way you're going to be able to see straight away has the leaseback price been added to the purchase price in the first place to negate a loss to the developer? Okay, does the software list public housing info as well? Yes, it will. And when I say it will come down as the owner. When you're actually looking at doing the research on the property, it will give you, and this is state dependent too, states such as, I think Western Australia are coming on board, but definitely Victoria and Tasmania, you will not get the owner's name or the information about the owner, like phone numbers and so on. Reason being, there's different privacy laws in different states, and both Victoria and Tasmania are probably the most stringent where you can't get that. But as far as the public housing listing, especially here in Queensland and so on, yes, you can actually see it says as the owner, the public list, the public trustee for the Department of Housing of Queensland, for example, or New South Wales. It will actually say that in the ownership of the title. Okay, is the Australian market still growing? What is the net effect on positive cash flow? I normally start doing somersaults when people talk about the market, and if you call it the Australian market, as we talked about before, every suburb is its own market, and one suburb can have more than one market. So I can't generalize about that. There is just too many variables. There is property clocks moving at different stages all around Australia for both states, both markets being the actual suburbs, and the dwelling types of whatever the demand is for what we spoke about earlier. So there's probably 100 answers to that question, which I could never do because it's way too generalized. We need to drill down more to be accurate. Okay, hi, is there any coding information available for an area? Example, if we are looking at the corner lot or the other in a specific area, is it possible to find out on face value that the property is big enough for a granny flat subject to council approval under the code or dual lock or so on? Same thing again, but yes, you can find this out in each and every individual property. Now, let's say, I presume from the question of this gentleman, it's probably in New South Wales. So whatever council you're in, you're going to be looking at and saying, okay, you need to go on first to the council website. This is before you start searching, okay? And see for the zones that you're looking in. So let's say we're looking at a low to low, medium residential. If we know by looking at the zone codes for the council that the properties that you're going to look for that sits within, let's say the minimum that we can actually go down to have a granny flat is 800 square meters. Now, when we get that information, that's when we go start searching. Okay, we're only going to look at houses with a greater land area of 800 square meters or more. Then once we find something that we believe is okay, we'll click on the resources within the property. This is basically in the software. You know, when I actually had those examples for just a single property and so on the right-hand side, when you open up further information, there is a full tools of resources, which I didn't have time to go into further tonight. And if you click on the relative council to wherever the property sits within, will be in that resource code. Click on that, go into the actual council. There's a myriad of different things. It's called PD Online is the most common, which is property development online and so on. Go in there to the local council, and at the bottom of your actual opening of whatever the property is, it will tell you what the zone of the property is. Go in there, put your address of the property, and there's not many councils in Australia where you can't do this. Your specific property address will come back, and it does take some drilling down in some councils, but some is quite easy. It'll come back and tell you what the zone is, and it'll come back too with neighbourhood overlays. These are the important documents that you need to read, because a zone is a generalization of the possibility. The overlays and also the neighbourhood planning policies and so on are the weeds that tell you what you can and can't do within those zones. So you can look at any property and do your research that way. The same thing. Do all your research without spending any money, but it's going to give you all the ticks in the boxes on the way to saying, okay, this is looking like something I will be able to get through. So of course, the more and more questions you ask yourself and the more ticks you do through your research, the more and more likeliness, whatever it is you want to achieve, you're going to do. Okay, next one. Thank you, sir. Yes, I am in New South Wales. Yep, not a problem. How long does it take you to find a property? Look, it's going to come down to strategy. And what we talked about before, when I'm personally looking for a client, I'm very upfront that I don't give them any false pretenses and so on, because it comes down to the money first. The money governs what we can and can't do in areas and possibilities. So it doesn't take, if I'm given enough money within the strategy to go hunting for and a realistic area and expectations of what it is for it, I can find a property in half an hour. And I could have researched about 2 or 3 on the way to that. But of course, if it's something very specific, like I want a subdividable property and I want it within 10K of a CBD and I want it for this price and I prefer a corner block, of course, if it's not available for the parameters that you're looking at, you're not going to find it. When that happens, generally increase your money, like as far as the search, dramatically, and that will show you if that is possible in the area, but it'll also show you whether it's realistic what you're expecting for the money that you've got to spend. Okay, from 1st of July 17, no depreciation claims on used houses, so reduced tax savings for new investor. Yeah, that's correct. There's been a lot of changes. Now, of course, I am not a tax agent or a financial advisor, so I can't really answer questions on depreciation and so on, but the gentleman that put that forward, yes, that information is definitely changing. Yeah, as I said, I'm not qualified to answer that. So, but I can nod my head when I'm reading what you're saying. Okay, so we're getting close to the end of questions. If anybody has any further ones before we sign off. Okay, I'll just give it another minute or so. Okay, guys, it doesn't look like anyone has any more questions. So, look, I really hope you enjoyed the presentation tonight. As you can hear, I get quite passionate about this because this is something I really actually enjoy, not something I just do for a job. So I believe anything you enjoy, it makes you better at it. And I'm definitely quite adept to finding things on this software, and I believe you can too. As far as the capabilities from it, if you're going to be doing any type of comparables for your own house, before or after renovation, as we talked about, buying purely for cash flow or for measuring your actual properties that you've already got, it's a fantastic tool. It really is. So get on board if you're one of those first 20. I wish you the best of luck in your future investing, and I will touch base with you guys in the coming days. And for those of you I don't talk to, have a really good Christmas and a successful New Year. Good night to you all, and thank you very much for attending. Cheers.